Today, we're wading into some pretty charged financial waters. We are focusing on a stock that, frankly, Wall Street just loves to hate right now. PayPal Holdings, ticker PYPL.
Yeah, the consensus view is overwhelmingly bearish.
It is. I mean, you look at the major outlets, the mood is bleak. PayPal's trading near $58 a share.
Which is dangerously close to its 52-week low of 55.
Exactly. The market seems to have decided this is dead money. A company just struggling to stay relevant against giants like
Apple Pay.
Apple Pay, which is, widely seen as eating away at their market share.
And that narrative, that fear, is what's driving the price down. But we've been digging into an analysis report that offers a profoundly contrarian view.
Yeah.
Our mission today is to really examine this report. It argues that this beaten-down tech giant is actually undergoing a quiet but really fundamental transformation.
A transformation into what exactly?
Into a unique kind of investment class, dividend plus growth. The analysis suggests the current valuation is so disconnected from reality that PYPL might just be the ultimate deep value play for 2026.
Okay, let's unpack this. If the sentiment is really that bad, what is the core bull case the market is completely missing here?
It starts, and in many ways it ends, with the valuation. Just the sheer gap between the company's financials and how the market is pricing them.
Right.
The report highlights a staggering number. PayPal is trading at a price-to-earnings ratio, or PE, of just 11.71.
I see that number, but let's put it in context. Why is an 11.71 PE such a headline figure for a tech company?
Well, because it's a historical anomaly, and that anomaly implies just deep, deep pessimism.
Okay.
Historically, PayPal, as a leader in payments, it consistently traded above 50 times earnings. 50?
During its growth years, yeah.
And even today, its competitors are often trading above 30 times earnings. The S&P 500 average is in the low 20s.
So when you see a global leader at 11.71, the market is basically pricing it like a boring bank.
A boring, slow-growth regional bank, or maybe even a utility company. This valuation, it doesn't just assume slow growth. It fundamentally implies zero future growth.
Or worse, that its cash flow is about to fall off a cliff.
Exactly. And that's the opportunity. The analysis lays it out pretty clearly. The stock is priced for obsolescence.
So if they deliver any decent growth numbers at all, the potential for upward movement is huge.
Right.
We're talking about more than just earnings growth here, right? We're talking about what analysts call multiple expansion.
Precisely. This is the crucial concept you need to grasp. Your return isn't just linear.
What do you mean?
Well, if PayPal's earnings go up by, say, 7%, the stock should go up 7%. But with multiple expansion, the market suddenly wakes up and says, wait a second, this isn't a dying bank.
It's a global payments leader.
Right. And if that PE ratio reverts from 11 back towards, say, a more reasonable 20 or 25, that's a separate, massive gain on top of any earnings growth.
So you get a dual boost, one from the actual financials, and a second, maybe even bigger one, from restored market confidence.
That's where the truly explosive returns are generated in value investing.
Okay, before I move on, I have to play devil's advocate here. If the value is so obvious, why hasn't some big activist investor stepped in to force a change in the narrative? What are they waiting for?
That's a fair question, and the report does touch on that. It points to some recent management instability and just the competitive fog. Activists like to see a solid floor.
And a clear path forward.
Right, and that leads us perfectly to the next point, the new dynamic that's changing the risk profile.
Yeah.
The income angle.
Right, this is a huge shift. PayPal isn't just a speculative growth stock anymore. The analysis details their commitment to returning capital,
Turning it into a true dividend plus growth play.
They've established a quarterly dividend of 14 cents, which at current prices is a dividend yield of about 0.96%.
Now, a 0.96% yield might not, make you drop your coffee.
Especially compared to a 5% CD.
Yeah. But the strategic significance of this is enormous. It's not about the dollar amount. It's about the signal.
What signal is that?
It signals management's absolute confidence in their cash flow. They're saying, we generate so much reliable cash, we can commit to distributing it quarterly, even while we're investing in the future.
And for the investor, it acts as a buffer.
A crucial psychological and financial buffer. Yeah. It starts to attract a whole new class of investor pension plans, endowments funds that are required to hold dividend-paying stocks.
So the story changes from holding a risky tech stock and just hoping for a bounce to I am now getting paid to wait for the turnaround.
Precisely. It fundamentally changes the downside risk. For you, the listener, if you're looking for stability with that growth potential, that dividend is a non-negotiable part of the new thesis.
That makes a lot of sense. But let's circle back to that central criticism. The reason the PE is at 11 is because the bears say PayPal is, dying.
Irrelevant, shrinking, bleeding volume, we've heard it all.
Here's where it gets really interesting, because the analysis report just throws cold, hard financial numbers at that narrative.
Numbers that show it's still an exceptionally robust and growing company.
Right. Reported revenue hit $8.4 billion in a single quarter. That's 7% year-over-year growth.
And 7% in this macro environment is solid. But the real rebuttal to the bear case, it's in the cash flow.
Okay.
In that same quarter, net income was $1.24 billion.
Right.
And free cash flow, the actual money left over, hit a colossal $1.7 billion.
That is an immense amount of cash. So connect the dots for me. If Apple Pay is supposedly eating their lunch, where's all this cash coming from?
That's the key to the quiet transformation they talk about. The bears focus on the consumer checkout button, but the real growth engine now is their back-end service, Braintree. Braintree handles payments for massive companies. We're talking Uber, Airbnb, major ticketing platforms. That's the high-margin piece of the business that's driving this FCF surge.
And the 7% growth isn't just an accident.
No, it's strategic. Management has been culling low-value inactive accounts. It's a move that temporarily suppresses user metrics, but it dramatically increases profitability per account.
So they're choosing quality over quantity.
It's exactly. This is the financial discipline of a transforming company, not a dying one.
So we have a company focused on high-margin services, still generating $1.7 billion in free cash in 3 months. It really forces you to ask the report's central question. Does a dying company generate almost $2 billion in discretionary cash in 1 quarter?
It doesn't add up. It clearly contradicts the whole narrative of collapse.
And that cash isn't just funding the dividend.
No, it's bolstering their already formidable fortress balance sheet. They're sitting on about $14 billion in cash.
Which gives them huge strategic options.
Huge. Aggressive share buybacks, targeted acquisitions, you name it. When you combine the revenue growth and that massive cash pile, the dying company narrative just collapses under the weight of the data.
The fundamentals seem undeniably strong, but the sentiment is weak. That suggests an opportunity, but timing is everything.
Let's shift to the technical setup. What is the chart telling us?
The analysis in the report noted that the stock has been consistently bouncing off this critical $55 to $58 zone. And for those who can't see the chart, what does that price action actually mean? What is the investor behavior there?
It shows capitulation followed by a fierce defense. The repeated dip to that level and reversal forms what analysts call a classic double bottom. You can almost see a W shape on the chart.
Okay.
Psychologically, it means every time the stock falls into that zone of maximum pessimism, strong institutional buying floods in. It's defining a predictable floor.
So the technicals actually support the fundamental argument.
They complement it perfectly because it defines a very clear, very favorable risk-to-reward scenario for you, the investor.
Explain that.
Well, if you end around, say, $58, the analysis suggests a very tight risk profile. You can set a firm stop loss just below that floor, maybe at $54.
So your potential downside is limited to just $4 a share.
Right. But the potential reward is huge. Analyst consensus targets cited in the report, they anticipate a multiple expansion. They see the stock returning to the $78 to $80 zone.
So you're risking about $4 a share for a potential gain of 20. That's a 5-to-1 risk-reward ratio.
Exactly. That ratio alone makes the setup attractive, even before you factor in everything we just talked about with free cash flow and growth. The technicals are confirming the fundamental value.
So what does this all mean? We've looked at the valuation disconnect, the income kicker, the financial proof, and the technical timing. The combined bull case from this report seems pretty powerful. You're looking at what they call a cash printing machine at 11x earnings with a strategic dividend kicker.
The market is reacting to fear, to uncertainty, to FUD. But the underlying data is reacting to profit and growth.
So the conclusion of the report is
emphatic. They argue the current $58 level is a gift for a long-term portfolio. They end with a strong buy-rye recommendation.
Why are they so confident?
Because they believe the market just hates the current uncertainty. And that uncertainty is the single source of this depressed price. Once that clears, as management keeps executing, the price should revert sharply toward its real value.
The price is being driven by sentiment, not by the failure of the actual business.
Exactly. The business itself is still generating immense profit through these strategic shifts that nobody's talking about, like Braintree.
Okay. That leaves us with a final provocative thought for you to explore. If we accept that digital payments are fundamentally not going away, and we've established PayPal's immense $1.7 billion quarterly free cash flow, how much does the current noise from competitors like Apple Pay actually erode that foundational cash flow? And if that financial strength is truly undeniable, how long can its PE ratio really stay so disconnected from its own history and its competitors?